Welcome to the best crypto trading course for beginners. My goal when creating this course was to make a free cryptocurrency trading course that's better than the courses that people are selling for thousands of dollars, and to do this for free on our YouTube channel. And inside of this cryptocurrency trading course, we're going to cover a lot. I'm going to assume that you're a complete beginner. You don't know really anything about trading, and we're going to walk you all the way up to like an advanced level of trader, at least to the intermediate level of trader. But the difference is I'm going to make things really, really simple. And also I'm going to share with you information that not a lot of other people have access to, because I've had the chance to partnered with a guy that's actually been trading cryptocurrency since it was like 1 penny. So he has over a decade worth of experience, and I'm going to teach you everything that I've learned to become a profitable cryptocurrency trader. So with all of that being said, let's dive into this. This is how it's going to be broken down. It's going to be broken down into multiple videos. Okay. The first video today is going to be part 1 about the crypto basics. Step 2, we're going to be talking about charting. Third, we're going to be talking all about indicators and how most of them are BS and which ones you should actually pay attention to. 4, we're going to talk about trading systems and what are the components of a trading system and a profitable trading system. Part 5, I'm going to talk about our favorite cryptocurrency trading strategies. And don't just go skip ahead to that point right now, or else you're going to miss all this other important foundational stuff that we build upon each video. And number 6, we're going to cover trading psychology, because even if you know all the basics and you know how to actually execute a trading strategy, a lot of the times people can't become profitable because they have it all messed up in their head and they think about trading wrong. Okay, so we're going to talk about that. Now, make sure that you like, subscribe, and turn on post notifications so that way you don't miss the future videos that are coming out on each one of these different topics. So today in the first video, we're going to be talking about the crypto basics, and I'm going to assume that you don't really know a whole lot about trading, and we're going to bring you up to speed. So we're going to go over choosing the right broker and why this is one of the most important things to becoming a profitable trader. We're going to be covering the basics of TradingView, which is our charting tool. I'm going to cover what are the X and Y axes and what do you need to know about them. We're going to be covering different time frame analysis. We're also going to be covering candlesticks, and we're going to be talking about the constant war between buyers and sellers. We're going to talk about cryptocurrency trading pairs and order types and which assets are the actual best to trade. So let's go ahead and let's dive into this right now into, first off, choosing the right broker. So choosing the right broker is one of the most important steps in becoming a profitable trader, because a lot of the times brokers can be scams, or they can actually take a large percentage of your money by causing outrageous fees. So the first thing that you want to look for in a broker is 1, you want to look for one that has low fees. 2, you want to make sure that it has a variety of different tradable assets. 3rd, you want to make sure that they already have a large number of customers served and it's not some new flash in the pan exchange that comes up. 4, you want to make sure that they have great customer service. Ideally, if they have live chat support, that's fantastic. Next is you want to make sure that it has an easy interface to use. And let's go ahead and talk about this. So there's a lot of different brokers that you could use out there. The one that I happen to like to use is called KuCoin. Okay, KuCoin is great because they don't ask for all of your information. They've been around, they serve tons of clients, they have really, really small fees, and they actually offer live chat support, which is one of the few brokers that I know of in the cryptocurrency space that actually offer that. And they offer a lot of other cool stuff about different ways that you can earn passive income. They have a great, easy to use interface. So I use KuCoin. You're welcome to use Binance. If you already have an exchange set up, then that's totally fine. The rest of this tutorial is still going to be useful for you because most of the interfaces are very, very similar. So with that being said, if you'd like to sign up for KuCoin, I did include a link in the description below, so that way you can save even more on your trading fees. So once you have a brokerage set up, then obviously you're going to want to fund the brokerage. So you can either send cryptocurrency directly to your brokerage account, or the cool thing about KuCoin is you can actually pay and buy crypto with your credit or debit card. So it makes it really, really simple to get your money onto an exchange, so that way we can begin trading. The next thing that you're going to need before you get started is our favorite trading charting tool called TradingView. So you can go on over to tradingview.com and you can actually sign up for a free account. They have a web version of this, so you can analyze everything on the web like this, so you can see the charts. But this is basically going to help us with different charting tools that we're going to be talking about. So you can do it online, or you can also download their app and you can actually have it on your computer, or you can also have it on your phone. So this is called TradingView. So make sure that you set up a TradingView account if you're unfamiliar. We're going to be using TradingView a lot throughout the rest of this tutorial and course. So make sure that you have an account already set up. The next thing that we're going to be talking about is actually the X and Y axis. So when you're looking at a chart, you'll notice a few things. You'll notice that on this Y-axis here, we have price, and on this X-axis here, we have time. So we can also change the time frame, which we're going to get into later, but basically you'll see that the time changes down here. The date and where the price has been at also changes here, okay? So this is the X and the Y axis. So this is what we're looking at. And then on the chart, we see these little things called candles, okay? Each one of these candles represents a period of time. So for example, if I go to the daily chart just like this, each one of these candles actually represents one day. Now, here's how to better understand candles. The candles are made up of 4 different parts. There's the low, the high, the open, and the close. And essentially, the low is the lowest that this candle has gone, or that price has gone during this, for example, 1 day time period. The high is the very highest that the candle or that the price has gone during this 1 day period. The open is what's the session actually opened at. So when the day actually started, where was price? And then the close was at the end of the day, where was the closing price? Okay, so if it's opened here and it closed here, it printed a green candle, which is a bullish candle, which basically means that there was more buyers in the market than there was sellers. Now, on the opposite side, we have bearish candles, which are represented by red generally, where you can see, again, we have the high, the low, the open, however, is here, and the close is here. So it means that at the start of the day, price was here. The close of the day, the price was here, so it was less. So this is a bearish candle or a downward candle. This would be an upward candle or a bullish candle. But generally, you'll be hearing the words bullish, which means price is moving upwards, or bearish, which means price is heading downwards. Okay, here's another way to look at a candlestick is we can see this is the daily candlestick, which again, we have the open, the close, we have the low and the high of the candle. So this is obviously a red candle because it closed further down than when it opened. But also if you break that down into the 4-hour time frame, we can see that each one of these candles represents 4 hours, which in total, there's 6 of them because 6 times 4 equals 24 hours, 24 hours in a day. You have the daily candle. So on the 4-hour, we can also see it. So we can see the very high during this day time frame was this candle here. We saw that it opened right here. We saw that this session closed right here. And we can see that the low was all the way down here, which it's the exact same price points as we see in this daily candle. However, we just see this broken down into 6 individual 4-hour segments. So with that being said, there's a lot of different what are called Japanese candlestick patterns, and each one of these patterns has a different psychology and means something different. So I'll go ahead and I'll just point out some of the most common candlestick patterns that you may want to look for. So this is a very common candlestick pattern. We saw a red candle here, and then we see a very big green candle right next to it, which completely engulfs the previous candle. So this is what's called a bullish engulfing candle. And generally when you see this, price generally heads on upwards, okay? The other type of candle, or the reverse, would be like a bearish engulfing candle. So this would be an example. You see this big red body that's engulfed the previous entirety of this candle. So this would be a bearish engulfing candle. One other candlestick pattern that you may want to pay attention to is something called pin bars. And a pin bar is basically, it has this body up here and then it has a long wick. And you can think of the wick is basically these top ends or this bottom ends. These are called the wicks of the candle. And then this center area is called the body of the candle. But as we see here, we have this smaller body and we have this long wick. So what is this telling us psychologically? It's telling us that price tried to go down here lower, but it didn't want to. And actually price ended up coming up here. So basically, this is psychologically telling us that the bears tried to win over here. They went all the way down here, but the bulls came back and they fought it all the way up to this point. And this is generally a likely scenario where price is going to continue on upwards. You can also see this candlestick pattern in the opposite direction. You see this smaller body with this long wick up here, which basically means that price tried to go higher. It really didn't want to go higher. It closed all the way down here, right? And this is generally signs that the bears are in control and that price is likely to move lower. Now, there's a whole myriad of different candlestick patterns, but these are kind of just the most basic, commonly used ones. Now, let's talk about the battle between the buyers and sellers. This is what actually gets price to move. There's a constant battle between buyers and sellers. And anytime that you're buying a cryptocurrency, that means that there's somebody on the market that's actually selling you this cryptocurrency. Or anytime you're selling and you're able to actually sell, that means that there has to be on the other end a buyer. So there's always this constant battle of buying and selling that's happening in the market. And that's really what the charts end up making up. And that's what these candles make up, is it shows the psychology of what's happening in the market between buyers and sellers. Okay, now we're going to be talking about cryptocurrency pairs. So what are cryptocurrency pairs? You'll notice that whenever you're trading an asset, you're trading it against some other asset. So in this instance, you see that there's BTC USD. This is called BTC. In this case, the first one is called the base currency. And then the second one is called the quote currency. So the base currency is Bitcoin. The quote currency is the US dollar, okay? And you'll notice that it's always traded in pairs. And you can see here's Ethereum US dollar. So Ethereum in this case is the base. The US dollar is the quote currency is what it's called. But you're trading a pair. You have to trade one asset for another asset. Now, in this scenario, we can see that if price is going up, then we would want to buy Ethereum US dollars. So we're buying Ethereum because we think that Ethereum is going to go up in price relative to the US dollar. And not always is it tied to the US dollar. In this scenario here on KuCoin, you can see this is Ethereum Bitcoin. So Ethereum in this case is the base currency and Bitcoin is the quote currency. So in this scenario, if we think that Ethereum is going to go up more than Bitcoin is going to go up, then we'll buy ETH BTC because we think that ETH is going to become more valuable compared to Bitcoin. Now, before we get into the different type of market orders and what assets are actually the best assets to trade, go on over to Instagram and go to Blue Edge Crypto and follow us. I want to send you a free report, which basically is going to show you 7 different passive income opportunities that you can earn with cryptocurrency. All you got to do is go on over to Blue Edge Crypto on Instagram and message us the word passive. And when you do that, we're going to send you a free report with our 7 favorite ways to earn passive income in the cryptocurrency ecosystem. Okay, so now we're going to talk about different order types. So these are the most common different order types. So what does this mean? When you go to actually place a trade, there's different options that it'll give you on how you can place this trade. So let me explain what this means. So now we're going to talk about the most common order types. Now, what does this actually mean? This means that when you're going to actually place your trade, say you want to buy Bitcoin or you want to sell Ethereum, there's different types of orders that you can make in order to execute it. I know this may sound a little bit confusing, but I'll make it really simple, okay? So there's market orders, there's take profits, there's stop losses, there's trailing stop losses, there's buy and sell stops, and there's limit orders, okay? So let's get into what each one of these means. The first one is called a market order, and you can either buy or sell at the market price. So what does this mean? This means that you're going to instantaneously enter the trade at the best market price that's available right now. So no waiting, for example, you just get right in. You can either decide to buy or sell whatever the price of the asset is right now, okay? The next type of order is what's called a take profit. So for example, let's say that you put a market order right here to buy and you then want to take profit up here. This means that basically when price reaches that point, you're going to sell the asset and it's going to convert back into a profit for you, right? So you can set this order on the brokerage that you're trading with. So that way when price hits there, you automatically take profit. Now, the next thing is that you could do this in the opposite direction. So say you're taking a sell order right here. Say you're doing a market sell order, meaning you're getting into the market right when the market price is available. And you put the take profit down here. It's down below because we're expecting price to go lower. So when price comes down here and actually hits this, then you will be taken out of the trade and you will earn profit. Okay. Now, the next thing that we're going to talk about is what's called a stop loss. Okay. And what a stop loss is essentially, let's say that we want to sell right here at the market price and we want price to go to this point, this is our take profit, well, we may also want to put a stop loss right here. And essentially what this means, if the price goes against us, okay, and we're losing money in this case, we want to get completely out of the market at this stage right here. Okay, so if price comes up to here, then it hits this, then we'll get taken out. So that way we cut our losses lower. Now in the opposite direction, again, let's say that we put a buy order right here and we put our take profit right here and we put our stop loss down here to protect our bottom downside. Price comes up here, boom, in this case, and it hits your take profit. However, if price were to come down here, it'd hit our stop loss and we'd get taken out of the market right there. The next thing is what's called a trailing stop loss, and this is a little bit more advanced, but basically, let's say that we put a buy order right here. Let's say that price moves on up to this point. We can move our stop loss or trail our stop loss. So essentially, let's say we put our stop loss right here when price is up here. This basically moves our trade to break even at this point once price has risen. Let's say that price rises again, we can continue to trail our stop loss. So this way we're locking in profits and we're actually limiting our downside. So again, price moves higher, we move our stop loss even higher, and then boom, we get cut out right here, okay? But we capture a big portion of this move thanks to a trailing stop loss. The next type of order are what's called stop orders, okay? And you can have a buy or a stop order. For example, you want to enter the market as soon as price gets up until this point. So you'd put a buy stop here, and when price moves past this, you automatically enter right at that price there. Okay, so for example, price comes up, and as soon as it comes up and it hits this line, then we'd actually enter the trade. Okay, so that's a buy stop. Now a sell stop is the total opposite, right? We could put a sell stop down right here, and when price moves to this level or past this level right here, this is where we're going to enter the trade. So we would have entered the trade right there, okay? The next type of order is called a limit order, okay? And you can have a buy limit or you can have a sell limit. But in this case, let's say that price is here, but you think that's too pricey, that's too expensive. I want to wait for price to come down here until I actually enter my order. So you'd wait for price to come down here, and then once it comes down below and it starts coming back up, you'd actually enter the trade right here. Okay, same thing with a sell limit. Let's say that you think that price is going to come up here before falling even further. Then you put a sell limit right here. It would come up here and it'd come on down. Okay, so you'd enter the trade right here. So these are the different types of market orders. So we've covered choosing the right broker, trading view, X and Y axis, time frames, candles, buyers versus sellers, pairs, order types. Now we're going to talk about which assets are best to actually trade. Now, when trading cryptocurrencies, you want to make sure that you're trading the best assets to trade. Now, with cryptocurrencies, since there's like 10,000 different cryptocurrencies, sometimes it can be difficult to get in and out of certain trades to find somebody to buy if you're selling, or to find somebody to sell if you're buying in this scenario, because there's low liquidity. What does that mean? That there's not enough people actually trading this market. So when you're trading, you only want to trade coins that have a lot of volume or that have a high market cap. So generally, it's a safe idea if you're going to be day trading cryptocurrency that you probably just want to trade cryptos that are like within the top 10 or maybe within the top 25. Anything outside of that, you may get stuck with liquidity issues where it's hard to sell your asset when you're ready to get out, and you may get stuck holding something longer than you'd like to. So primarily, we actually like to trade just Bitcoin and Ethereum. They're very, very volatile assets, and they're also very liquid assets. So that means we should have no problem getting in and out of trades, okay? Now, we've covered a lot in this video, but the next video in this series is really important. Now we're going to start getting into charting. Okay, so we're going to be talking about things like support and resistance, and what most people tell you about support and resistance is just a complete lie and is inaccurate, actually. Second thing, we're talking about trend lines, and we're going to be talking about chart patterns. And in that video, I'm going to show you a couple secret chart patterns that not a lot of people talk about, but once you understand these chart patterns, you'll be able to accurately predict when the market's likely to start flying off in certain direction. So make sure that you like, subscribe, turn on the post notifications so that way you don't miss the next video in this series. And we'll see you in the next video.